way ahead just by holding gold, which pays no interest and earns nothing but dust sitting in a safe. So the point of it is that the exercise in precious metals is one of preservation. And it's not about getting wealthy. It is wealth, but it is wealth that has a way of keeping up with the debasement of the currencies around us. And, there was the incrementum, I think it's called. They do that huge gold report every year, and they had a chart going back in just about every single major currency. For the past 25 years, the average annual return is between 8 and 11% across the board in all the major currencies. So, it's sometimes return on your money is not really as great as return of your money. And I think that's what we're trying to talk about with gold and silver. It's not about getting wealthy. It's that it's a return of purchasing power, let's call it. And it doesn't continue to slide away from us the way that this dollar does. And the illusion that we're only at 3 or 4% inflation is nonsense. It's more like 9, 10, 11% inflation, but I digress. Anyways, it's important to understand that. And that's, I think, really the whole idea of owning gold and silver is that, if nothing else, throughout all of time, it has proven to retain its purchasing power and in some cases even increase it.
On today's market recap, silver price retreats amid strong U.S. dollar. Silver drops in late trading impacted by a strong U.S. dollar and falling Treasury yields. Remains technically bullish, trading within key Fibonacci levels from 2433 to 2978. Resistance at 2770. Support at $27.05. Market trends could push price to $28 or below $27. Silver price slid late in the North American session due to overall U.S. dollar strength across the board amid falling U.S. Treasury yields. Despite that, the trade's at $27.23, down 0.71%. The gray metal remains upward biased despite retreating toward the $27.20 area on Tuesday. It should be said that XAG USD is still trading within the 50% and 38.2%. If silver buyers would like to regain control, they must clear the 38.2% Fibo retracement at $27.70. Once surpassed, emerge key resistance levels, like the $28 psychological figure, followed by the 23.6% Fibo retracement at $28.49 ahead of $29. Now we'll show you the best clips related to gold and silver of the latest interview, our beloved Andy Schectman. But first, smash the subscribe button, hit the like button, and turn on notifications so you do not miss out our daily recaps. Enjoy the episode.
Commodities. And when we talk about the LBMA, largely the Chinese have involved themselves in what's called exchange for physical. And usually that ends up in buying COMEX contracts and delivering them in London. But what we've seen recently is a huge amount of kilobars, I think it's called the mini contract on COMEX, that have been delivered to the Brinks facility in Hong Kong. And there is a COMEX Brinks facility that is largely only delivered into when it is exchanged for physical. And the author who talked about this very eloquently said what is happening is that they short the price of metal, then buy the physical for delivery off of COMEX into Hong Kong, COMEX Brinks facility, and then truck it to the Shanghai Gold Exchange, where it is then sold, to this mass exodus out of the Shanghai Gold Exchange, where they're delivering many times what the COMEX market does every day. And this is how countries are sidestepping sanctions. Like Iran will sell their oil to China for yuan, which is immediately convertible into gold on the Shanghai Gold Exchange. And for all we know, it's the kilo bars that left the COMEX that were delivered to the COMEX approved depository in Hong Kong, then trucked to the Shanghai Gold Exchange, and then sold to Iran as they cash in their yuan that they use to, buy oil with or sell their oil with. And this is exactly this slow process of bleeding down the exchanges. And absolutely, when you look at the LBMA, they have the lowest level of silver that they've had maybe ever in the 140-year history of the mint that isn't already encumbered, belonging to ETFs and belonging to other entities. And when you realize that Gordon Brown sold the majority of all of their gold, there's no wonder that they're saying, we'll buy it back, even if we didn't produce it. That reeks of desperation. And, so again, I I don't know how much time is left in all of this. I don't know when we're going to see the big move in gold and silver that we've all been anticipating, but certainly you can see it all around us in terms of geopolitical events, political events, moral, social. And then you see a mint like this saying, we'll take anything you want to sell, even if we didn't sell it to you. And we never did this before, but we'll do it now. It just tells me that the hour is drawing nearer before we see some sort of gold revaluation. And, you keep hearing that gold revaluation. Well, look, it's ironic that the central banks hold gold in their central bank accounts in an account called the gold revaluation account. You look at their balance sheet, that's what it says, the gold revaluation account. Roosevelt did it. He confiscated gold, which I don't see them doing this time because everyone owned gold back then, not now. It was currency back then. But then he devalued the dollar by 40%, making gold, go up 40%. And you got the head of the Dutch National Bank saying the same thing. This is what we should do. And a lot of people saying this is what we will do. We will just revalue the price of gold, and that will get our balance sheet in order. One that is continually denigrating by the day to the tune of, $100,000 a second that we are adding in debt to $1 trillion every 100 days. And yet we continue to borrow money and give it to other countries like the Ukraine, $60 billion, and chastise and call names to our congressmen and women who would have the audacity to question the sanity of maybe just putting America first once. And I think this is, you put it all together, you start to see just what it is that I'm talking about. And, I hate to be this pessimistic about things, but yet the lunacy continues. And, no more so than what we saw in the Jared Bernstein interview. I hope everyone checks it out if they haven't seen it by now. But there is lunacy all around us. And most of the people watching this show probably would have a better idea of how to run the government's finances on a big picture than the people that we are putting in charge. And this is starting to have consequences around the globe, not just in the United States.
In today's market recap, China's $170 billion gold rush triggers Taiwan invasion fears. Beijing on record 17-month buying spree in what experts say is a move to guard against sanctions. Silver set to surge in 2024. Silver market continues to capture the attention of investors and industry stakeholders. Silver's unique properties, such as high reflectivity and excellent electrical conductivity, make it a critical component in numerous industrial applications. Factors influencing the silver bullish market in 2024. The ongoing supply challenges, including the deficits reported in previous years, will likely continue due to limited new mining projects and regulatory hurdles, particularly in significant silver-producing countries like Mexico. Additionally, geopolitical unrest, especially in Latin America, could further strain supply chains, enhancing bullish sentiments. On the other hand, economic and financial indicators will also play a crucial role. The interplay between interest rates and silver prices will be critical, with the Federal Reserve maintaining a hawkish stance amid inflation concerns. Now we'll show you the best clips of the latest interview, but first, smash that subscribe button, hit the like button, and check our links in the description for some massive sign-up bonuses. Enjoy the episode.
He's the lead economic advisor. Maybe I've been giving the guy too much credit. This is the guy who advocates for losing the reserve status, and I would make the connection of weaponizing the dollar and telling Saudi Arabia we're going green and giving him the credit for being the author of this theory. But I wonder if it's more along the lines of the people that put him into power just understand the guy is inept. He has a degree in music, I think, from Columbia University, where he studied the Cloward Piven theory, and at the same time, he has a master's degree in social work. This is the lead economic advisor to the U.S. government, who could not explain the simple question of how bonds, selling of bonds, provide the Treasury with money to finance their spending habits. And it was thoroughly embarrassing. And when I sent it to you a few days ago, I didn't get your I was out of town and I didn't get your reaction. But when I watched it, it was of embarrassment and shock that this is a guy that leads the Economic Advisory Committee in the United States White House. And I don't know if it's ineptitude or what, but it's something people should check out. It's truly shocking. And when you realize these are the people that are, and he is a modern monetary theorist, by the way, these are the people that are directing policy course, it's absolutely frightening. I think people need to take a look at it and wonder, is it ineptitude? Are our politicians that stupid? And as I've said, is it too stupid to be stupid? Or maybe they're just stupid. But it is one of the most shocking things I've ever seen for a lead economic advisor. And it explains a little bit as far as I'm concerned. But look, I think what the whole encapsulation of it is that when a currency is in terminal decline the way that ours is, I think it's easy to see it when you look at the issue of bond sales. And when governments around the world and entities around the world who hold our debt sell it, and the only entity left to buy it would be the Federal Reserve, who in essence creates money out of thin air to do so. Well, this creates currency devaluation, of course, but it is also the beginning of the end. This is the signal of a currency in terminal decline. And I think that's basically where we are at right now. And I think it's a phenomena that will only accelerate. Because if they raise rates, they bring down the whole house of cards, right? And if they choose inflation, which ultimately I'm sure that's what they will do, it ends up in higher interest rates, especially if it's the Fed who has to create money out of thin air to buy the bonds. And it's just like this new program that the Treasury is rolling out. The government is rolling out a new Treasury buyback program to support the largest Treasury market in the world, this engine of liquidity. The problem is that the Treasury is broke. And who's going to pay for the bonds? Who's going to buy back these bonds if the Treasury is broke, which we are? And the question is really an easy answer, has an easy answer. It's the Fed. The New York Fed will have to create money to buy the bonds, which again is monetization of assets. And so this whole charade is beginning to accelerate. So it's not higher for longer, it's higher forever. Inflation is not going away. They will not lower rates, no matter what the market is trying to say that they're going to lower rates here at the end of the year. They won't. They can't. And I think this is a new reality that people will soon begin to realize, that this pipe dream of a soft landing and lowering rates is, I think, off the table and out of the question. So I guess we'll have to see. But to me, rates are only going to go higher, and they will choose inflation over austerity the way that they have, all politicians have since the beginning of time.
What do you think of Schectman's take? Will BRICS master plan pan out, or will the dollar resurge from its ashes? Post in the comment section down below your honest opinion. Share this video with a gold bug and watch this video right here because you'll love it. I see you on the other side.